Hi there, welcome to Kneppy Invest. In this video today, I am going to discuss the current state of the markets. And when I'm talking about the markets, will be discussing the indices, three indices, the XJO, which is the ASX 200 companies, the S&P 500 and Nasdaq, which are looking at the American markets. I'll also be discussing some valuation models, including the CAPE or Shiller P ratio, Buffett's ratio, also looking at the interest rate model, because I do think it's very important to take into account what's been happening with the interest rates over the last 30 years. Now, I am recording this video on September 11, and personally, I cannot believe it has been 20 years since that fateful day. It is a day that has been engraved in my memory, and I'll never forget what happened on that day. I was living in Oklahoma at that point in time, getting ready for classes, watching one of those morning TV shows as it came on that a plane had crashed into one of the World Trade Center buildings. At that point in time, everyone was thinking it was a small plane. And then I just remember watching the second plane crash into the second building. At that point in time, it was quite clear what happened. I do remember quite vividly what I did during the rest of the day. And even though I was quite, fair way away from the areas, New York City, Washington, D.C. and Pennsylvania, there was still a lot of fear, and that fear lasted quite a while over the next few months. So it's a day that I'll always remember, never forget it, and it's also sort of the day where you don't want to relive again. In this video, what I'll be doing is showing you charts of different time frames. We'll be looking at daily, weekly, and even monthly charts. And the longest term monthly chart I'll be showing you is from 1983 to current period. And it's really good to look at these different time frames for charts because you do get different perspectives. Now, for the daily chart here with the XJO, it does look quite bullish. This is exactly the chart you want to see if you're an investor in the equity markets or if you are owning a company, because we do have the chart going from the bottom left to the top right. We have three moving averages on this, the 50-day, 20-day, and the 10-day moving average. And ever since the start of this year, any time the market or the XJO has fallen below the 50-day moving average, we have seen a rally to take it above the 50-day moving average. And right now, because of that 2% big down day we had on the 9th of September, it was the 9th of September, we are right now below the 50-day moving average. And the last two times that it has happened, we have seen a rally almost immediately. So even though the American markets were down on Friday by between about 0.5 and 0.8%, there is a possibility we might rally as sort of, what do you call it, sort of a buy the dip sort of mentality that a lot of investors seem to have. And you actually can see the buy the dip mentality when we look at the S&P 500. Now, there is a possibility we might actually drop a little bit further from here because of that down day in the United States. And that might lead to some speculation that this bull run has come to a completion, because it does look like there is potential, if we have some more down days over the next week, that this long-term uptrend might be coming to an end. So that's why I'm very curious about how the XJO and the Australian markets go about their business in the next week. As we move on to the S&P 500 daily, I'm not going to show you the Nasdaq, just the S&P 500. This is a definite buy the dip scenario. We've seen this happen around about 7 times in this year alone. So we had a buy the dip in late January, early February, another buy the dip in March, another one in April, another one in May, another one in June, another one in July, and another one in August. And you can just see, as soon as the market or the S&P 500 gets right on the 50-day moving average, it bounces almost the next day. It's been doing that consistently during this year. Right now, in fact, the S&P 500 is not near the 50-day moving average, so it's a little bit more bullish than the Australian markets for some reason. I'm not sure what's been happening, but we can see in this chart on the Friday, the S&P 500 did fall by something like 0.7%. So this actually does look a little bit more bullish than the XJO. Now I'm just going to look at some weekly charts. And the first stop is the XJO, which goes back to 2008 during the global financial crisis. And from the bottom, or around that time, we have been trading in this channel that is sloping up. And every single time we get to the top of that channel, which has happened about, well, there was 3 rapid times in 2009 and 10, and there was another time in 2015, and once just before the COVID-19 financial panic, and we're there again. And every single time we get to the top of that channel, we do see a little bit of a correction. And every time we get to the bottom of the channel, which has happened 1, 2, 3, 4 times, and during the COVID-19 financial panic, we fell straight through the bottom of that channel, but then we recovered very quickly. So I'm sort of discarding the COVID-19 financial panic because that was a bit of an outlier. But it seems every time we get to the bottom of that channel, we go for a nice rally. And every time we go to the top of that channel, we see a bit of a correction. And right now, we are at the top of the channel. In fact, a few weeks ago, we went above the top of the channel, and as soon as we went above the top of the channel, the market started to pull back, and now we're below the channel again. So right now, we might see a little bit of a correction. Who knows how long it will take before we get to the bottom of the channel. It could take quite a few years because at times the distance between the bottom of the channel is about 4 or 5 years. And so we might be still waiting quite a few years before we get to the bottom of the channel. But right now, looking at the weekly XJO, it is looking a bit toppish. When I look at the XJO daily and weekly chart, there's nothing untoward there. There's nothing to indicate we're in for a major crash in the markets. But when we look at the American indices, the S&P 500 and the Nasdaq, I am seeing something a little bit different. So this is the S&P 500 weekly going back just like we saw in the XJO towards 2008 and 2009. And at one point in time between 2008, or one period of time between 2009 and 2017, just like the XJO, the S&P 500 was trading in this channel. However, since about 2018, when we went above that channel, we've seen an exponential rise in the S&P 500, particularly over the past year. And you can see how quickly the S&P has risen during that time period. And this does make me a little bit nervous, a little bit wary about buying into the American markets, because whenever you see this sort of rise, more than likely there will be a serious correction in the future. And I'll talk about the Nasdaq, and then I'm going to compare what's happening with the Nasdaq now to what we saw during the tech bubble. So wait for that slide later in this video. And this exponential rise in the American markets is even accentuated a little bit more when you look at the Nasdaq Weekly. A nice uptrend during 2009, or from 2009 to about 2016. So the market was doing really nice things. It was a very orderly uptrend at that point in time. But ever since 2016, we've just seen the Nasdaq start to accelerate upwards. And right now, you cannot argue with me that this is not an exponential rise in the Nasdaq from about 2016. You can just see it accelerating up and up, particularly over the past year or since the bottom of the COVID-19 financial panic. So again, just the fact that the Nasdaq is exponentially rising does make me a little bit nervous, a little bit wary, because whenever you see the market or any stock price for a company rising exponentially, there is always going to be followed by a correction, and sometimes a serious correction at that. Now onto some monthly charts, and the first up is the XJO Monthly. This goes back to 2003, which was the start of that bull run that preceded the global financial crisis. And we saw the market go from about 2,800 to a top of 7,000, almost 7,000, 6,800. The numbers I have here are the number of months in a row where we saw the market rise. So 10 meant the market rose 10 months in a row, twice during that bull run between 2003 and 2007 or 8. The last time that happened was back in 1986 and 87, just before that big crash in I think it was October 1987. And then we saw the global financial crisis in 2007 and 8. Then we saw a nice little rebound in 2009 when the market rose 7 months in a row. But you can definitely see that upward sloping channel the XJO has been in since 2008. And the only time it has fallen through on the downside below that channel was during the COVID-19 financial panic. We saw the market rise twice, 7 months in a row back in 2009 and then again in 2019. But right now, we've just seen the market rise 11 months in a row from, actually it was October last year. So the last month we saw the market fall was September 2020. And before September 20, we saw the market actually rise 5 months in a row. So that means over the last 17 months, the XJO has risen 16 months. So only 1 month it has fallen. So we've never seen a rise like this in the XJO before. And right now, I'm recording this on the 11th of September, actually the XJO is down for the month. Whether it remains down for the rest of the month remains to be seen, but we are at the top of the channel. We need a bit of a correction here to put a little bit of perspective in where we are right now. That is very healthy to get a little bit of correction, in my opinion. When we turn our attention to the Nasdaq Monthly, going back to 1998, and the reason I went that far back with the Nasdaq was I just wanted to include the tech bubble and the tech bubble burst because it puts everything in perspective. Just see where the Nasdaq is right now compared to 1999 and 2000. And we did see the Nasdaq go into this nice orderly uptrend between 2009 and 2016. But ever since 2016, we've just seen the Nasdaq accelerate upwards. And this sort of exponential rise in any sort of market or stock price or any commodity, anything, cannot happen forever. It's inevitably going to burst and we're going to see a major correction. And who knows when that correction can be. But the reason I am talking about this is I did actually listen to a podcast, I think it was yesterday, and in this podcast there was a question in regards to this person who has recently retired. And the main advice I think a lot of advisors give to retired people is put your money into safe dividend stocks. And this retiree said, why should I do that? And the return in that is like 5 or 6% per year when I could put my money in companies that are rising at 15, 20% per year, or put into a Nasdaq ETF. And people have this perception that the Nasdaq has been rising for a long period of time, say about 12 years, and it's going to continue forever. But this sort of action in the markets just cannot continue forever. And this is another reason why I'm a little bit wary now of buying into any American companies, because it is definitely looking a bit toppish. But we just don't know how long this exponential rise in the market can continue. But the longer it rises at this rate, the more likely we're going to see a major correction in the markets. When I looked at the Nasdaq monthly chart, I just noticed there was some similarities between the tech bubble and what's happening with the Nasdaq right now. So what I've done in this slide is just try to compare those two periods of time. On the top here, we have the tech bubble, and on the bottom, we have what's happening with the Nasdaq right now. This is still looking at the monthly time frame, and there's a lot of similarities when you do compare the tech bubble and the present day. There is a saying that history doesn't repeat, it just rhymes. And this is an instance where I do think it is rhyming. What's happening with the Nasdaq right now shows a lot of similarities to what happened with the tech bubble. And you can just see during the tech bubble, the Nasdaq started to accelerate, started to grow exponentially. And just before the bubble burst, that's when it was increasing at the greatest rate. Now, we haven't quite seen that with the Nasdaq. But since the COVID-19 financial panic, we have seen the Nasdaq starting to accelerate. So if we do see a few months where we see major gains in the Nasdaq, that would be a warning sign in my opinion. Now, there are reasons and explanations why we've seen the Nasdaq run up over the past 12 or 13 years, and it has all to do with interest rates. And I'll talk about interest rates, not the next slide, but the next few slides after that. When we talk about the CAPE and Shiller ratio, when we talk about the Buffett ratio, and when we talk about the interest rate model. The last chart I want to show you is the XJO Monthly, looking at a period between 1983 and 2021. There is a couple of reasons why I chose 1983. That was the sort of the bottom in the market in that period. And the reason we started to see the XJO rise is because 1983, or around that time, was when we saw the peak in interest rates. And from 1983, we have seen interest rates falling consistently. And the relationship between interest rates and equity markets should be converse. So as interest rates fall, equity markets and the attractiveness of companies should rise. And of course, the reverse is true. If interest rates start rising, the attractiveness of companies or equity markets is decreased. Now, I've also included here an uptrend, which is portrayed by this sloping orange line. And since 1983, the XJO has performed quite orderly, because every single time the market or the XJO gets towards this uptrend, we do see a bit of a rally. And that happened in 1990 during that recession. We also saw it in 1992. The XJO almost hit the uptrend during the tech bubble burst in America. It got right near the uptrend. We also saw the XJO hit that uptrend during the bottom of the GFC, and then again during the COVID-19 financial panic. But the rise in the XJO since the COVID-19 financial panic has driven the market to a point where the separation between the uptrend and the market right now is or hasn't been as large. You might argue that during the top, or just before the GFC, the distance between the uptrend and that point in time was the largest separation. So what is that telling? What is that telling us? Where we're seeing a large separation between the uptrend and the markets right now. Just all it means is the possibility of a bit of a correction in the markets is increased. That's all it is telling us right now. Who knows when it's going to happen? We might see the markets keep on rallying here, particularly if interest rates stay quite low or they get decreased again. So the markets are looking toppish whenever you look at the monthly or weekly charts. But when you look at the daily charts, when you look at a different perspective, we are still seeing the XJO, S&P 500, the Nasdaq still in a nice looking uptrend. The XJO is looking a little bit more dicey, but who knows what's going to happen over the next week. Now I'm just going to look at some valuation models, and this is the CAPE or Shiller P ratio. So CAPE stands for cyclically adjusted price to earnings ratio. Funny enough, in meteorology, CAPE is an acronym we do use for figuring out where storms might develop. That is convective available potential energy. So when someone talks about CAPE with me, I'm thinking meteorology, not the Shiller P ratio. So the Shiller P ratio, or the CAPE, is just the price divided by an average of 10 years of earnings for inflation. So it is adjusted for inflation. And you can just see this goes back to 1870, and you can just compare where we are right now to historical levels. So in Black Tuesday in 1929, the CAPE or Shiller ratio was 30. During the tech bubble, the CAPE ratio got to 45, and right now, on the 2nd of September, the PE ratio, or the Shiller PE ratio, is at 38.5. Now, one of the main criticism of the Shiller PE ratio is doesn't really take into account interest rates. And over the last 40 years, I've already talked about this, we have seen interest rates rise. So the lowest point in the CAPE or Shiller P ratio was in the early 1980s when interest rates were the highest. And ever since then, we have seen the CAPE or Shiller P ratio rise through time because interest rates have been falling. This model is from one of my favorite websites called currentmarketvaluation.com. So go to that to have a look at some of these models they do use. And this is the Buffett indicator model, looking at the ratio of the total value of the US stock market versus current GDP. And we have never been higher. So on the 2nd of September, the Buffett indicator model was at 243%. technically we should be moving towards that historical trend line. So there's always this thought of mean reversion. So there is this possibility that we might be dropping towards that historical trend line in sometime in the near future because of correction to the market. So this model is saying the stock markets, or particularly the I think this is based off either the S&P 500 or the Nasdaq, more than likely S&P 500, that we are strongly overvalued right now. But in saying all that, I've already mentioned a few times, interest rates have been falling over the last 40 years. So I do think you need to adjust for interest rates. And on that current market valuation website, they do have an interest rate model that does adjust the S&P 500 value to the current interest rates. And when you do adjust for interest rates, you do get a fairly valued S&P 500 right now. So we could still see the markets rise from here because based off interest rates at historical lows, maybe historical lows, there is still some value here. Now the question is, when are we going to see interest rates rise? They can't remain this low forever. There is suggestions they can remain this low for a while, but more than likely the next time we talk about interest rates rising or falling, it's going to be rising because they can't fall much lower from here. But the question is, when is that going to happen? And I do think when that does happen, when we see interest rates rise, that's when we might see a serious and major correction in the markets. That's all I have for this video on the current state of the markets, looking at the XJO, S&P 500 and the Nasdaq. I am thinking about doing a regular update on this topic, so maybe once a month. If you think that's a good idea or a bad idea, make sure you leave a comment in this video, and I'll take any comment you have to say on board in any future decisions I do make on this topic. Now, last thing I should say is I'm not a financial advisor, although I am an economist. So if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. If you do need economic advice, maybe I'm not the best person to talk about because I haven't used my economic training for about 25 years. That's it for this video. Have a good day. Bye.